Hey, Sean, welcome to the show. I appreciate you being here.
Lacey, always great chatting with you. Thanks so much for having me today.
Yes, I actually should have said welcome back to the show. That probably been the proper introduction. This is your,
It's all good, Lacey.
yeah, two times. Well, I was just browsing Twitter and I saw you talking about tax gain harvesting. And I realized I wasn't really familiar with that. And I thought that would be an interesting subject to talk about on the show, is because we were all preparing for tax season and starting to wrap our mind around things. And so I thought this would be a great topic. So I want to start with what I want to know most. What is tax gain harvesting and how does it work?
Yeah, so tax gain harvesting is a planning concept where it applies to those who have assets in taxable accounts. So we're not talking about 401ks, TSPs, Roth IRAs, any of that stuff. Put that to the side. It has nothing to do with tax gain harvesting. This is literally we own an asset, usually a stock, an ETF, a mutual fund in a taxable account. So that's the first thing to look for. Second thing to look for is at least somewhat low income, right? Tax gain harvesting doesn't work in our peak earning years at work and things like that. What we're trying to do with tax gain harvesting is take advantage of being in the 12% or lower federal marginal income tax bracket. And those brackets change every year. But it applies often if we're early retired, if we're late retired, maybe we took a sabbatical this year or had a layoff. And so our income is somewhat low vis-a-vis other years of our life. And we're able to keep our income in the 12% or lower federal marginal tax bracket. So it's an asset in a taxable account and a relatively modest to low income so that we're in the 12% or lower tax bracket. That's sort of the profile. And then what do we do? Well, what we're doing is we're saying, hey, we've got an asset with a big capital gain in it, usually an individual equity, but it could be a mutual fund, could be an ETF. And we're saying, oh boy, we don't want to pay the capital gains tax on that asset, right? If we sell it in many years, we'd pay a 15%, 20%, could even be up to 23.8%, depending on our situation, federal income tax on that. But this year, we're in the 12% bracket. That means we pay a 0% federal capital gains rate if we sell this year, right? So we're being opportunistic. So here's an example, right? Say you bought Apple stock in the 1990s and it's in your taxable brokerage account. You're sitting on that. You say, oh boy, I could sell that, but it's got a big capital gain. Well, yeah, but if you're in the 12% or lower tax bracket, you could sell a portion of it, probably not all of it, but a portion of it. And you can trigger that gain. It goes on your tax return. If you do it before December 31st, that's the 2023 tax return. Okay, so we trigger that gain. And because we're in the 12% or lower federal income tax bracket, we have a zero federal income tax hit on that. And that's the beginning of tax gain harvesting. Now, tax gain harvesting comes in two flavors, right? So let's keep going with that Apple stock example. One flavor is just called basis resetting. So maybe you like holding Apple stock, and we're not here to give investment advice on this podcast, but let's just say you've decided you like holding the Apple stock. Okay, sell a portion, keep the gain so that your overall taxable income is in the 12% or lower federal income tax bracket. You pay zero federal income tax on that gain as long as we keep everything in the 12% or lower. And then you can, the next day, go back on the brokerage and rebuy the Apple stock. Well, now you've reset the basis. So you now have a full fair market value basis in that Apple stock. That's called basis resetting. That's the first flavor of tax gain harvesting. Great. There's another flavor of tax gain harvesting I really like, and let's just keep going with the Apple example. You sell the Apple stock and you say, you know what? I don't like being in a concentrated position. I want to be in a different investment for whatever reason. Maybe you're going more towards bonds. Maybe you just want to be in an index fund. It could be for whatever reason. And all you do is you just redeploy the cash proceeds from the sale into a more diversified or a different investment that you now prefer. And what you've done there is portfolio reallocation, at least to a degree, and you've essentially improved your portfolio position without paying additional federal income tax. I really like that flavor of tax gain harvesting, but both flavors can absolutely be beneficial.
Can you touch on it for a second, people that aren't familiar with capital gains tax, like short term versus long term?
Yes. All right. So two things are going on with, well, more than two things, but let's talk about two things going on with capital gains. So there's two types of capital gains. One is short term, and that means we've owned the assets we're selling for less than a year. All right. If I go and I buy 5 shares of Tesla stock today, and then next week go sell those 5 shares of Tesla stock, and it has a gain in between when I bought and when I sold, that's called a short-term capital gain. And the thing about that is that's generally taxed at ordinary income tax rates. So we don't like that as much because maybe this year I've done really well and I'm paying a 32% marginal federal income tax, right? That gain is highly taxed. Depends on my situation, but that can be highly taxed. But then there's a second flavor of capital gains. Those are called long-term capital gains. Those are gains on assets we've owned for more than a year. All right, so long-term capital gains are gains that we've had on assets that we've owned for more than a year. And usually we want to have long-term capital gains, not short-term capital gains. Why is that? Long-term capital gains qualify for preferential rates, right? This is to encourage investment. There's a whole history about favored long-term capital gains rates. They've existed, they went away, they came back. The Congress wants to encourage investment, and part of the way they do that is through long-term capital gain preferential rates. And it's a progressive, it's a bracketed system. The cool thing about it is, under today's rules, if you are if you look at the ordinary rates and you're in the 12% or lower ordinary rate, then your long-term capital gains rate is generally zero. Okay. Once you slosh over that 12% rate, the gains above that go to 15%. And then at very high income levels, and I think it's over 500,000, you have to look married versus single, it gets up to 20%. But that's still preferred to then say 37% as your highest ordinary income tax bracket. So, Lacey, we are looking to, if we have a capital gain, we like it to be long-term rather than short-term. One other little thing that's going on here too, and we don't have to dwell too much on this, is short-term capital losses can offset long-term capital gains and vice versa, right? So you can offset these things against each other, and there's all sorts of planning that can be done there. It's not really tax gain harvesting, but that's a feature of these capital gains versus our W-2 income, our retirement income, these sorts of things.
A lot of people hear more about tax loss harvesting versus tax gain harvesting. You've just explained what, tax gain harvesting is. How is that compared to tax loss harvesting? There's a lot of harvesting going on.
Yeah, so harvesting is basically a fancy way for saying selling, right? So tax gain harvesting, we sell an appreciated asset, right? Like Apple stock we bought 20 years ago, to either reset basis or portfolio reallocate. Tax loss harvesting is selling an asset so that we can trigger a capital loss on that asset. And that can do two things for us, right? One is it can offset other capital gains. So maybe early this year, I sold an asset and had a big capital gain. I don't want to report that on my tax return. I mean, I have to report it, but I don't want to pay tax on it. So the way I don't pay tax on it is if I have a loss elsewhere in my portfolio, my taxable portfolio, I could sell that asset and trigger the loss to offset the capital gain I already triggered. Okay, that's one flavor. The second thing you can do is you're allowed to use capital losses to offset other income, W-2 income, IRA income, pension income, whatever it might be, up to $3,000 a year. So maybe, I go to work, I have a W-2, I make $100,000. And I say, okay, I got to pay tax on $100,000. I'd rather pay tax maybe on $97,000. So what I do is I look through my portfolio. I see the unrealized gain and loss column. These days, most of the brokerages will list that usually with like a green font if it's a gain, red font if it's a loss. And I say, oh, I own this mutual fund, this ETF, this stock, this bond, whatever it is. And it's showing me a $3,000 loss. Maybe it's a $4,000 loss, $5,000 loss, whatever it might be. Why don't I sell some or all of that, just trigger one capital loss on my tax return, report that, and take a $3,000 deduction for that loss this year, so that my W-2 income just went from $100,000 to $97,000, right? This is another one of these opportunistic planning plays. One of the cool things about this versus tax gain harvesting, and tax gain harvesting, if we're making too much money, it's just not available to us. We could be making $1 billion and still, in theory, do tax loss harvesting. There's no income limit in terms of the profile that qualifies for this. So tax loss harvesting, it's the sort of thing, if you have a taxable portfolio, generally speaking with financial assets, it's not a bad idea to, at year end, just comb through there. Hey, are there any built-in losses? And maybe I just sell those just so that I can trip a capital loss and then put that on my tax return and offset maybe some of my W-2 income or my IRA income, my pension income, whatever it might be.
For people that don't know, what's the difference between an unrealized gain and a realized gain?
Great question, Lacey. So an unrealized gain means you haven't sold it. So let's say you bought Apple back in the 90s and it's just sitting in your portfolio today, late in 2023 as we record this. You would see, there's a big unrealized gain in Apple stock. Now, if you go sell some of that, you now have a realized gain. Whatever you had 100 shares, each share had $1,000 worth of gain, say, and you sell, 2 shares, you just realize 2,000 of gain. A very simple example.
With tax gain harvesting, you mentioned that is good in years where you're not making as much money. Would you say that tax loss harvesting is in years that maybe you're making more money, or it doesn't matter?
I think that's a fair statement, Lacey, that the higher your tax bracket, the higher your marginal tax rate, the last rate you pay on the last dollar you earn, and we have progressive rates. So if you make $1 million, the last dollar is going to be taxed generally at 37%, if I'm recalling the brackets correctly. So it's going to be a little more valuable than if we're in a lower income situation in most cases. Absolutely.
What about people that are hearing this? There's a lot of moving parts, and to make those decisions, and taxes just sound scary in general. But then when you start talking about doing this, harvesting the selling, to have a tax strategy, how do you get the right person to help you with that? The right tax professional? Like, how do you know that they're doing a good job? Maybe they did your taxes last year, but there's no frame of reference. How do you know that they really did help you with your taxes?
Great question. And actually, that's the most difficult question you've asked, Lacey. So I will say it's very challenging. It's challenging for a number of reasons. I think we're dealing with the intersection of two different industries: financial planning and tax return preparation. So let's think about sort of how those industries evolved and how that connects here. So financial planning often evolved around managing investments. So there's a lot of, they call it assets under management advisors, where that's going to drive a focus on investments and less of a focus on tax. So the financial planning industry has really been biased towards investments and focusing their time and attention on investments and not so much on tax. That's changing very slowly. There's something called advice-only financial planning. I myself, right, I'm not unbiased in saying this. I'm an advice-only planner, so I like the advice-only model. Not all advice-only planners are tax, focus on tax, but there's at least more incentive potentially to focus on tax. So, there's financial planners. Hopefully some of them are dealing with tax planning, so that could be one avenue here. But, historically, it's been tough to develop that avenue. All right, now we think about tax return preparers. Think about preparing tax returns 20 or 30 years ago, right? The heavy lift just to get the returns out the door, plus when are they getting paid? How are they getting paid? They're getting paid for getting the return done. So they didn't focus on tax planning and tax consulting. So both industries, financial planning and tax return preparation, this has been sort of a dry spot, the planning, the consulting. Now, I've been working, I worked this year with a woman who has a small tax return preparation firm, and her model says, well, I'm not just going to do the tax return for you. If you want me to do your tax return, that's fine, but you have to agree that we're going to do planning during the year before tax return season. And I really like that model, right, where we're thinking about the tax return as the end of a process, not the beginning and end of a process, if that makes sense. I hope the tax return industry sort of moves in that direction where it's more of a relationship over a period of time where we're in the year, let's do some planning in the year, and then next year we'll do the tax return that will reflect the planning we already did during the previous year. So, yeah, Lacey, I think finding a professional that is planning oriented and tax oriented is absolutely a challenge. And I don't have the silver bullet. Oh, look for this credential or this network or anything like that. I frankly don't believe that there is a silver bullet in this regard. I think you just have to, what I would do is just interview different service providers. The nice thing about interviewing in today's age, this is an area where the end user now has an advantage, right? 10 years ago, you wanted to interview different service providers. You got to go drive to this office and that office. I live in the Los Angeles area. That's a pain. Today, you can find some intake forms on websites, schedule a 30-minute Zoom or Google meeting or whatever the software is, and the cost of having some introductory meetings with potential advisors has gone way down. So that is going to help the end user in terms of getting more tax planning resources.
I'm really glad I asked that question because I feel like that's for me personally. I grew up. My dad, as soon as I started working, I was required to do my own taxes. He just always wanted all of us to learn how to do that early on. And of course, very simple then. But then, sometimes you're working and doing all these things, trying to make more money. And then you get to a point where it's like, wait a minute, like this, I'm getting out of my depth, or this is not, something's changed. Like maybe you did make a lot more money or you made a lot less money, and not doing proper planning. I think that's probably hitting it like on the head, is that you should start earlier. You shouldn't be starting, January. You should have been actually, doing it. Well, I guess for the next year, you should be doing it all year long, preparing and making that plan instead of just having somebody do your taxes.
I think that's right. So people errantly think, well, I'm doing tax planning because I'm doing my tax return. I hired somebody to do my tax return. It's not really fair to the service provider, right? If you hire somebody just to do a tax return, that is a backward-looking document, right? That's looking at the past and trying to accurately report the past. And there can be little planning tweaks in that process, but real affirmative planning should be upfront and affirmative. The other thing too is, so we're recording this in late October, not to reveal too much behind the curtain, Lacey, but we're recording this in late October. And sometimes there's this sort of, I want to, at the year end, I want to qualify for every tax deduction I can. And I think I don't like that sort of plan. Now, yes, if you have some tax gain harvesting, you could do tax loss harvesting, fine. But what you should be focusing a little more on, in my opinion, is how do I set up 2024 and beyond my total lifetime tax? How do I think about that? That's, I think, the most valuable thing. That said, yeah, if we're in October, November, December, and we can flip the switch on a little tax loss harvesting, tax gain harvesting, absolutely do that. But I think you want to start to think a little bit more long-term versus short-term in terms of our tax planning.
Yes. I have found that in life and business is that when things go wrong, you want to have a team or the people that you need on deck, not looking for them and then starting to solve the problem. If you already have, your tax professional on deck, then you're able to do those things in advance and be on the offense instead of the defense.
Absolutely. Absolutely. And I think forming a relationship with someone who is planning and return oriented, it makes a lot of sense. And, I think sometimes people wonder, do I need a tax return preparer? I mean, some of the indicia that you do are, in this community, I bet rental real estate. I generally think if you've got rental real estate, you need a tax return preparer. What about a small business? That's another indicia. You probably need a tax return preparer. Look, there's some people who get, a W-2 or two and some 1099 DIVs and INTs, and that might be the entirety of their tax return. Oftentimes, that person doesn't need a tax return preparer. Look, if they just want to farm out the work, hey, this is one less thing on my desk, yeah, go for it. But, that is a situation where a DIY perspective might make a lot more sense.
Yeah, I think, too, in the military community, you move so frequently that you're starting over every time. And so you don't have that person. I mean, it goes like having a hairdresser to your barber to a tax person, an attorney. And so that's really difficult. But I think you made a good point. Like now the barrier has gone down in order to be able to meet people on Zoom and be able to connect with people virtually, remotely, I think is way better now.
I think that's right. One of the nice things about today's business climate is, look, yeah, maybe you could move and keep your tax return prepared. Now, sometimes with the states, that isn't as easily said than done. States are a whole other conversation in terms of taxation. But there are going to be people in the military who maybe move, but I know in the military sometimes you can keep the current state. Maybe you move overseas, so maybe that isn't as impactful. But yeah, it's absolutely something to be thinking about when you move. Is that the time to change tax return preparers, or maybe that's the time? Hey, we can have a conversation, and no, the move isn't as impactful as you might think. We could actually keep the same tax return preparer.
What is the top one or two mistakes you see people make with tax gain harvesting? Is it not fully understanding it, trying to do that on their own?
So I'd say the biggest mistake that one can make, and it's not a huge mistake, but the biggest mistake would be triggering too much gain. So, you have to look at the 12% tax bracket, and that changes every year. So how much income do we have this year already, and how much do we estimate we'll get in like dividends, more W-2 income, interest income in December? And okay, so we slot that in our little spreadsheet, and we know the top of the 12% bracket because we go to Dr. Google for that answer. And we say, all right, how much gain are we going to have? And we have to remember the gain counts. So let's say the top of the 12% bracket for a married couple, when you factor in the standard deduction, it's around $100,000. I don't know the precise number. They change every year. I myself go to Dr. Google if I'm really.
I don't know it off the top of my head either.
So,
Sean,
but let's
so
say it's around 100.
Me.
Yeah, it's around $100,000 for 12% married couple. We got the standard deduction. And by the way, it could even, if you have itemized deductions, maybe it's really higher. But if we're talking about gross income, about $100,000, let's say we think, hey, we're going to have $80,000 of other income, W-2, whatever it might be. Oh, well, we could sell and trigger a $50,000 gain, and that'll be all 0%. Well, no. If let's just use 100,000 as the top of that. 30,000 in that example, right? The first 20,000, yes, 0%. It fills up the top of the tax bracket. But the next 30,000 would be subject, because it would push you into the 12% or the 22% bracket in my example. The next 30,000 would be subject to 15% long-term capital gains rate. So I think just understanding that the gain itself matters, and you can't just trip $1 million gain and say, well, I was in the 12% bracket otherwise, so I have zero capital gains.
Like, I'm good.
So just understanding that, so just understanding that, I think is sort of the biggest mistake that could be out there. In my little example, yeah, you trip 30,000, that sloshes into that 15% long-term capital gains bracket. But maybe you were doing it for portfolio reallocation purposes, and maybe that's okay. Maybe you're like, look, I still got 20,000 tax-free federally, 30,000 goes to the 15% bracket, and I improve my portfolio position. Maybe that's still a net win. But yes, from a pure tax perspective, that wasn't, let's call it, optimal.
Okay, I got a couple of quick random questions I want to ask you now that I ask everyone. First off, what is one resource or tool that you use that makes your life easier?
It's funny, Lacey, I'm going to say conferences. So I have a little YouTube channel, Sean Mullaney Videos. I encourage everybody to go visit it. I went to a conference in August where I learned how to properly use my microphone. I hope the audio is working here today. Without having gone to that conference, I'd be still using my microphone wrong. And it absolutely makes a difference in terms of audio quality. And that's just one area of my life where conferences have helped me out, right? They help me out professionally. They help me out with my YouTube. They help out with networking, learning all sorts of lessons, getting my mind thinking, hey, you know what? This is some content creation I could do that would be helpful to my audience, that people would be interested in. So I'd say conferences, especially this year, have been a really good tool in my life.
I probably should go to that conference. In fact, my editor's probably like, I wish she would learn how to use her microphone. What conference did you go to you learned that?
So that conference was Podcast Movement. It was outside of Denver. It was back in August. And, I actually don't have a podcast, but I like to say I'm podcast adjacent, right? Because I have a small YouTube channel. I guest on podcasts such as yours, Lacey. So I'm very, I'd like to say I'm podcast adjacent. YouTube and podcasts are also sort of merging a little bit these days. So it was very helpful to attend that conference, even though it's not what I do professionally. And I don't even technically, I don't have a podcast, but I do have a YouTube channel. And it was very helpful. And they had a bunch of sessions just on YouTube. So it was very helpful.
Okay, well, I'll be sure to put links to that for everybody in the show note. Okay, next question. What's your favorite book right now or your favorite book of all time?
Well, I'll say this. My favorite book of all time is obviously the Bible, right? I read the Daily Gospel every day on my phone, usually, every now and then on my computer. In terms of the personal finance space, I'll just give you two books, right? They're both chestnuts, right? The Millionaire Next Door and J.L. Collins' The Simple Path to Wealth. I think there's still plenty of really good lessons in both of those, even though those are both now. I think Simple Path to Wealth was in about maybe 15 years old, 10 years old, something like that. And Millionaire Next Door came out, I believe, in the 90s, but both are still very applicable to today's environment.
I'll be sure to put links to all of those in the show notes. Now it is time for my favorite part of the podcast, which is game time. And today, in honor of your visit and the fact that you're a Jets fan, we are going to play Fact or Fiction New York Jets. So we'll see if I know nothing about the New York Jets and very, very little about football. So we are just going to see if ChatGPT is telling the truth about the New York Jets. So we might have to phone a friend on this or Google it, but we'll start. Number one, fact or fiction? The New York Jets home games are played at MetLife Stadium.
That is a fact.
Okay. I'm glad we're off to a good start. That's what it says. All right, number two, fact or fiction? New York Jets have won the Super Bowl at least once in their history.
That's a fact. They won Super Bowl III in January of 1969, but they have not been back to the Super Bowl since.
That's impressive. You even knew the year. It is in my notes here. Okay, number three, fact or fiction? The New York Jets team colors are green and white.
So all right, we're going to have to get a little technical here. So
okay.
That is mostly correct, and I actually wish it was fully correct. So officially, the Jets now have three team colors, to my knowledge. It's green, white, and black. Technically, black, I think, is a team color of the Jets. And in fact, it's not just green, white, and black. It's like Gotham green and Spotlight white. And there's, so they came up with these adjectives. This was part of a new uniform they came out with 4 or 5 years ago. I didn't really like the new uniform. And they're actually now doing throwback uniforms. They did it twice this year. They look excellent, so much better. I'm hoping they go back to these 80s throwback uniforms, which were only green and white. So, Lacey, I don't know if me and ChatGPT are agreeing, disagreeing. Maybe that's a 0.5. I think I had a better answer than ChatGPT in that regard. But I will say, if they just said green and white, that's pretty dang close.
Okay, that's what they said. It is green and white, but I feel like you definitely won out on ChatGPT on the details. I had no idea. Okay, so you definitely got number three right as well. Okay, number four. The Jets' main divisional rivals are the New England Patriots. Fact or fiction?
Boy, so that's a matter of opinion, right? I would say so there are three teams.
ChatGPT is giving off an opinion then because they only gave one answer.
All right, so the Jets are in the AFC East. The other three teams are the Miami Dolphins, the Buffalo Bills, and the New England Patriots. And boy, who is the Jets' main rival? I will say, I think, that's one of those gun to your head. One day I might say the Dolphins, one day I might say the Bills. But I think sort of over time, I'd say yes, the Patriots probably are our main rival.
Okay, well, you got that one right too, but I might need to feed that back into ChatGPT and let them know that that's an opinion. Okay, number five, fact or fiction? The New York Jets have never had a player inducted into the Pro Football Hall of Fame.
That is absolutely fiction. So, for example, this year we had two inducted into the Hall of Fame, Joe Klecko and Darrelle Revis. There's plenty of Jets. Joe Namath's in there, Don Maynard. So there's plenty of Jets in the Pro Football Hall of Fame.
Well, you got it right. You got 100%. You definitely have bragging rights that you won Game Time on the Military Money Show and that you're a diehard Jets fan. I'll now know that about you, Sean. You've proven it. You've proven it. Well, I appreciate you being on the show, playing the game. Can you tell everybody listening where they can learn more about you and what you're up to?
Absolutely, Lacey. Thanks so much again for having me. Pleasure chatting with you today. So my YouTube channel is Sean Mullaney Videos. You can reach me on Twitter at Sean Money and Tax. I guess it's X, right? So on X, Sean Money and Tax. And then my blog is FITaxGuy.com.
Wonderful. I'll be sure to link to all of that in the show notes for everybody. Thank you again, Sean.
Thank you, Lacey.